The following is a paid program with the information provided by the sponsors and host of the show, not by News Talk 720 KDWN. The content does not necessarily reflect the views or opinions of this station, its employees, ownership, or management. The broadcast of information on this show does not create an attorney-client relationship with any of the listeners. Communication between the listener and the hosts of this show will not be confidential. The information provided on this show is prepared for a general audience without investigation into the facts of each particular case and is not to be considered legal advice. The information provided on the show should not be used as a substitute for legal advice. The listener is advised to consult with a qualified attorney on any legal issue they may have. It's time for News Talk 720 KDWN's Legal Hour. Have a legal question? Call now 257-KDWN. That's 257-5396.
And good morning. Welcome to the KDWN Legal Hour. Wednesday morning, 9:06. And Wednesday means real estate law and Tisha Black from the Las Vegas firm Black and LoBello. Good morning, Tisha.
Good morning, good morning, good morning. Today, as I said last week, we had a lot of callers call in last week about the HARP program. So I rummaged through my Rolodex, if there is such a thing these days, right? And came up with my friend Mark Baker, who's from Sierra Pacific Mortgage, and is one of the most knowledgeable people that I know on the HARP program. So I am bringing you here today so that you can answer some of the questions that we had last week and hopefully some callers we get this week about exactly what HARP is and how it can help people. So thanks for coming.
Thank you.
So tell us about HARP. What is the HARP program?
The HARP program is the Home Affordable Refinance program that the federal government has rolled out. President Obama flew into town, last October, I guess, September of October, and said we're going to allow people nationwide to be able to refinance. Las Vegas is one of the hardest hit.
This is the one where he stood in front of the stucco house with the nice family right behind him and talked about how he created a program that's going to help everybody, and it was this HARP program, correct?
I didn't see him, but I believe you.
He'll be back this morning if you'd like to go and ask him.
That's exactly right. He will be here this morning. I have
He's
heard.
in Boulder, right?
Mm-hmm.
Yeah. Talking about, what's he talking about?
Energy.
Energy.
One of that big solar plant.
That's right. I didn't realize that Boulder has the largest solar plant in the country.
You've got to get out of the city limits.
I know, I really do.
Got to get out and explore. Leave the valley.
I got to get out from behind my desk is really what I got to get out from behind. The only time I crawl out is when I come here, as you could tell, right? Okay, so the HARP program. Let's talk about that because it started on the 15th of March, right?
Mm-hmm.
And it hopes to refinance people. Now, let's just use a hypothetical. I live in Las Vegas. I'm not late on my payments. This is hypothetical, although I do live in Las Vegas. I'm not late on my payments. I have...
we don't have to be hypothetical. I live in Las Vegas.
Okay, John.
I'm not late on my payments, and I have an FHA loan.
Okay, here we go with John. And
so what can I do?
How much is your house worth?
A lot less than what I paid for it.
Okay.
I believe like 148, 152, somewhere in that range.
And what's your loan?
My loan was for 228.
Okay. So he's underwater. And he's looking to, and you've paid, right? You're never, okay. And he's never been late on a payment. And he's coming to you because he wants to know about the HARP program. Take it away.
There's nothing you can do because you have an FHA loan.
All right, there we go.
So it only allows for people who have a Fannie Mae or a Freddie Mac loan.
Okay,
so
and how do you figure that?
You can go to FannieMae.com or you can go to FreddieMac.com.
Okay.
Or if you can't remember those, you can go to NevadaHarp.com, like a lady playing a harp. And that's a website that we've put up, and we have the links below. There's several videos there that we're giving updates throughout the process. There's 2 links below there, so you can just click on those, and it'll bring up a separate web page.
Oh, so you don't have to toggle back and forth between the other two.
So you just go on there, and
okay.
you can do the search and find out if you do have a Fannie Mae or a Freddie Mac loan.
Okay.
So what happens is there are a lot of people like yourself that have an FHA loan or a VA loan, or there's many, many people that have a conventional loan or a jumbo loan that doesn't qualify. So it only affects Fannie Mae or Freddie Mac owned mortgages and they had to have been acquired by Fannie or Freddie before June of 2009, which is another major sticking point.
Of 2009 or
Correct.
2006?
2009.
June 2009.
Mm-hmm.
So that's not that bad, really, because most people haven't even been able to get a new loan since,
Well,
2008 or
we've done a
9.
few loans. I mean,
No.
we're still doing loans.
But I'm talking about people. A lot of people were in the market for loans.
Mm-hmm.
Obviously up through the bubble, 2007, right? 2008,
Right.
2009, it got harder, but people were still doing it.
Right.
So that's actually a wider net than I thought. I thought that it was 2006,
Mm-mm.
and it's 2009.
It's June 2009.
Okay,
So
June.
we had a borrower in our office just last week. Great borrower, excellent FICO scores, great debt to income ratio. I mean, strong borrower, plenty of money in the bank that wanted to refinance. Everything looked good, smelled good, tasted good, the whole 9 yards. We run the loan through the system. Monday morning yesterday, today's Wednesday, right?
Mm-hmm.
Monday morning, 2 days ago, loan wouldn't go through the system.
Why?
Because they closed on their loan, I want to say, at the very beginning of May or at the very end of April, and the loan was not acquired
In time.
in time.
So let me ask you this. Can people get a principal reduction with this program?
No, they cannot.
How does it work?
It's just a refinance, a rate and term refinance. So we take whatever your current balance is, we lower it to whatever the going rates are, plus a small fee for the federal government, basically the Fannie Mae or Freddie Mac delivery fee. And the rates are actually pretty strong. They're not quite the same rates that you get if you're purchasing a home or if
Right.
you've got 20 or 30% equity, but they're pretty close. They're within an eighth usually.
Okay, so let's say hypothetically John has a Freddie loan that qualifies.
Uh-huh.
Really all it's going to do in this refinancing is
Just
adjust
lower the
his
interest rate.
interest rate.
Lower the interest rate. There is no principal reductions. They don't do anything with the unpaid principal balance. We call the UPB in the business.
Okay.
They don't do anything with the unpaid principal balance. They just literally refinance it, rate and term refinance. The closing costs.
Do they extend the
are
term?
normal. It's a brand new loan. So you can do a brand new 30-year fixed, which would lower the payment the most. You could do a 20-year fixed, 15-year fixed, whatever you want to do.
So with people that are in a Fannie or a Freddie and they've got an outdated interest rate in the sense that it's elevated in comparison to today's market,
Right.
and they're way upside down in their house, or they're, I would say, moderately upside down in their house, this would be a really good move for them.
Absolutely. It would be a strong move for them, especially if they're planning on staying in their property. There's a lot of people right now that are still trying to make the decision whether they want to do some type of a strategic default or, whether they think it's worth it or whether they want to keep their kids in the same school district, et cetera, et cetera. So
I have a friend of mine I have a lot of friends in the real estate business, but one that I think is particularly good at what she does. She does a lot of short sales. And she's telling me right now that the market is absolutely a bear trying to short sale because there are a lot of sellers who just are ambivalent now. They don't care. They don't care what the price goes for. They don't care how easy they make it. All they care about really is what the bank is going to give them. And I can see that. I mean, having struggled through 3-4 years of this with the banks and the programs and the this and the that and the other thing, I was hoping that HARP program had an element of principal reduction in it because I think for most people, the hope is gone, despite the fact that we still have Obama, right? But the hope is gone if they don't get something that's really going to help them with what is the business decision of having a home, the investment of having a home. They're going to bail. So for this program, I think is a great program, but it sounds like for the people who will qualify, right? It's terrific. And if you qualify, I still think that it's probably only a better business decision when you're not too upside down in your property, right? Because if you have a house I had a client come in yesterday, their loan is $400, their house is worth $200, and when they bought it, the house appraised, of course, at $620, something like that.
right.
And not late on their payments at all. Both financially squared away, have worked very diligently to get rid of, or to keep other houses and modify those terms to have some rental properties. He's gone from working one job to 3 jobs.
Sure.
And it doesn't sound like, though, this HARP program would really help them that much because they're $200,000 underwater.
Yes and no. I guess my first question, if he went from working one job to 3 jobs, did his income go down or something?
Oh, yeah, he has a hardship.
Okay, so there's a legitimate hardship there. What we're seeing is a lot of people have there's not a quote hardship. There is a, let's put it this way, there's a non-willingness to pay because they're so far upside down. It's just that
exactly.
simple.
Yeah, because they're looking at it going, I'm not even renting my house right now.
That's exactly right.
I'm throwing money in I'm driving down the freeway in a flatbed with money flying out the back.
Mm-hmm. There's a lot of people that feel that way. We've had that NevadaHarp.com, the website that we put up, we've had a lot of interest in that. We've had, I want to say, 100-ish people that we've got on a list to refinance. And
from the website.
Yeah, just from the website.
Well,
that was
it's
up.
really thorough. I mean, I was poking through it last night, not as much as I should have, and then briefly this morning before we started the program. But it really is thorough. And for me, I'm an attorney. The HARP program is more. It's your wheelhouse, obviously, as a mortgage lender. So I had questions, and your website actually answered a lot of my questions. So it definitely is worth it. NevadaHarp.com.
If you'll dig through that website, we've put up the actual bulletins and releases from Fannie Mae and Freddie Mac. So we're trying to be fairly transparent so people can see exactly what's on there.
Well, you know what? There was another thing that President Obama was saying that I caught on, what was I listening to? Bloomberg, I think, the other day, where he said that he is paring down the refinancing, the costs of refinancing, that each household that was going to be refinancing would save $1,000. Have you heard anything like that?
No, I don't know what that's in reference to.
Well, and the reason that I thought that was crazy too is because one of the things about the HARP program that makes it a good program for those that qualify is that they don't really pay attention to the LTV, right? To the loan to value.
That's according to the Fannie Mae and Freddie Mac releases. That is correct.
Okay, but
that's not what's happened in reality.
Right, reality. There's lending overlays, right? Mm-hmm. That make a difference. So people, when they actually go to, for lack of a better word, a broker, right, to look at getting into this HARP program, the broker is going to care about what the LTV is. Is that what you're saying?
Yeah. What's happened is they just rolled the program out for Fannie Mae.
Right.
Freddie Mac still is not. Freddie Mac has released what they said that they're going to do, but they haven't had many lenders pick it up. So, in other words, the mortgage company that I work with, we're in the top 20 lenders in the United States. We're licensed in all states, and we're big. We're huge. And excuse me, our company has taken a stance that we're only going to, well, I shouldn't say our company. Most mortgage companies have taken a stance that they're going to limit the loan to value regardless. So Fannie Mae and Freddie Mac, I mean, I specifically have been calling Fannie Mae and Freddie Mac personally and talking to them.
Can I have that number?
I could get it for you. I don't have it with me, but I could get it for you.
I'd really like to have that number.
I can get that to you. You just Google Fannie Mae, it's right on there, Freddie Mac. So, but we've called them and they said, yes, there is no loan to value limits. However, now that all the guidelines have been rolled out,
right,
we've only got 2 lenders that we can deliver loans to and or broker to that are doing unlimited loan to values with Fannie Mae, and we have 0 with Freddie Mac yet.
Right.
Even though,
so that's going to be the issue. So there again, now you're going to have another problem.
Yeah. So here we are in Las Vegas. We've been taking the loan apps, putting the files together.
Right.
In the last week. Now we've disclosed to them, which we have to do by federal law. Now we're trying to run them through the system.
Right.
And they're 170 or 180 or 190% loan to value. Well, most of the caps are at 150% loan to value. And, I'm talking to other lenders around the United States.
This was the same thing that we went through when we went through the multi-state settlement program, and we were looking at what, the AG one that I've talked about is Nevada is the hardest hit. I mean, our values have dropped the most. That Florida and California by volume have more people.
Right.
But ratably, we're the worst, right? Because we have one in every something like 17 has
something
an
like
issue.
That,
right.
All the sand states.
Right, but
Arizona
we're the
is
worst.
bad.
But
we
we're the
are the
worst.
worst. We're the epicenter.
Right. So when you're ground zero for this problem and you have the high, the most out of whack LTVs, it doesn't matter what program they come up with. If they're going to do anything nationally, like the national banks do, like the federal government does, they're going to try to hit the sweet spot, which and get the most people, right?
Correct.
In the center. And we are never in the center. We're on the fringe in terms of the battered state we're in.
No question. No question. And the problem is the lenders just don't want the risk. Even though the reps and warrants, how do I put it in layman's terms? Even though the reps and warrants, when we fund a loan, we still have to sell that off to Fannie Mae or to Freddie Mac or whoever we're going to sell it to.
Right.
They have to acquire the loan. Just recently, and I guess it's no big news.
Because really nobody wants to hold on to a 30-year note.
Well, not only that, who wants to do a loan, especially with this HARP thing? I mean, if I drove my 2004 Chevy Tahoe into you and it was worth $8,000, you're not going to lend me $20,000 on it. You'd be a fool if you're a financing company to lend me $20,000.
If she does, let me know.
Yeah, but you see what I'm saying?
Yeah.
And we've got the same thing here. We've got people that have got an asset that's worth $150,000, but yet they owe $300,000. Who wants to give that person a loan? It's like a hot potato. The current lender that's got it, you got it. Congratulations. And so what Fannie Mae and Freddie Mac have said, listen, we've already got it. So we're going to lower their interest rate.
Because maybe what they're trying to do is have people avoid the strategic default. We have a caller, and I know that there was a couple on there earlier and they dropped. I'm sorry.
Let's go to Mike. Mike, good morning.
Good morning. Thanks for taking my call. I'm considering strategic default, and let me tell you what the number one motivating factor is. and I don't know if I can get them to foreclose or short sell my house in time, but it has to do with the Debt Forgiveness Act expiring at the end of this year.
That's
because I don't want that hanging over my head. Here's the way I'm looking at it. My wife and I wanted to keep this house.
Right.
And we can, right now, we can keep this house. We're paying through the nose for it because I'm underwater about $200,000. But, I mean, the guy next door buying the same house has got less than half of the payment that I have now, which is fine, but I can afford it. But my concern is going forward, if I don't get out from under this thing and something should happen and we happen to lose our jobs, the economy gets worse, and through, we end up having to go into foreclosure, we're going to get nailed with a huge tax bill.
Oh, absolutely. Absolutely. There's a and what you're talking about, just to make it clear so the rest of the listeners know, we've talked about it before on this show, is the tax forgiveness that you would have normally if you're forgiven a debt, which is typically the deficiency now on a foreclosed home or a short sale home. If the bank doesn't force you to pay, in your case, the $200,000, then for tax purposes, it's got to be treated as income. And when it's treated as income, then you've got to pay the tax associated with that forgiveness of debt. And so up until December 31st, 2012, if it was a debt that was generated or utilized for the purchase or improvement of your primary residence, then you won't have to pay the income tax associated with the forgiveness of that particular debt. And there's no reason, it's totally the elephant in the room to me. I can't believe that Obama has got, himself geared up for $1,000 savings for people who refinance, and most of the world can't refinance because generally they'll make you pay the difference of the loan to value before you can refinance, so people can't afford it.
That's correct.
But I can't believe that he's spending time on that measly bleep $1,000 savings when we've got this issue that Mike's pointed out, which is if they don't extend this tax exculpation for forgiveness of debt in relation to primary residence, it's going to be unbelievable. We have teachers, we have police officers, we have and our average income is much lower than it was in 2006-07. We'll have a $200,000 debt. For a normal person, that's a bankruptcy right there.
Right. So my question, it leads me to this other broader issue in Nevada that let's say I'm unable to short sell the house, and I just say, you know what, I'm not going to pay anymore. I'm just going to go into strategic default here. I'm in a category where I don't have a Freddie or a Fannie loan, and if the bank, because Nevada, it's my understanding, Nevada has a law that if the bank can't prove the documents that they have the document. My loan was securitized, is what I'm trying to say.
Okay.
And I think there's a great possibility that they're not going to be able to prove it up, that they're going to be unable to foreclose in Nevada.
Well, a couple of things with foreclosure in Nevada. You brought up like 6 different topics there.
I was going to say that you've got a lot of different things here.
But you know what? Since I hear the music now in my ear, Mike, hang on, because you've got issues regarding some new laws that are passed, some deficiency actions. I want to talk about the reality of foreclosure and deficiency actions on the banks and a couple other things when we get back. So hang on the line, and we're going to go to break, and we'll be back.
And we were talking to Mike when we went to the break.
Okay, so Mike, I'm so glad that you called in because, and sorry for the other callers right now, but we've got a lot of stuff to talk about in this, in your one question. So to recap, Mike's got a conventional loan. He's $200,000 underwater. He's financially, we'll say, stable, right? But you're considering a strategic default because of the sunset on the tax exemption for forgiveness of debt related to a primary residence, right?
Correct.
Okay. So, you know what? I don't know that a strategy for you, I don't know that a strategy for you would really be, a rational strategy for you would be to strategically default into a foreclosure. And the reason is because if you have a securitized loan, the national banks, which are servicers still for securitized loans and their own portfolio loans and a host of other loans for that matter, aren't filing notices of default in our state. A lot of people want to say it's because of 284, which I'm sure in large part it is. But if you look nationally across the country, foreclosures have been lower for a while. They're just not pursuing foreclosures with any kind of speed. And I know before 284 came in effect, the average for a foreclosure was somewhere in the neighborhood of 411 days. And so banks are just not foreclosing with the rapidity that they used to. Now, I think that has to do with the multi-state. I think that once the multi-state is solidified, you'll see them foreclosing because they're basically getting a wand of forgiveness waved over all their bad acts. And I think that they'll continue to pursue them, and you'll see more foreclosures. But for your situation, Mike, that tax exculpation comes up at the end of the year. I don't think you could get your house foreclosed on in time. And so I think that probably a short sale is a better way for you to go, which, is going to open up your financial panties, if you will, to the bank because they're going to want to see a lot of information from you.
Wow.
Right.
That's what it is. Do you want to get, you have somebody
exactly
looking
right.
in your drawers.
You got to be willing to open up the kimono. That's
Right.
exactly right. But you better do it quick because, Tisha's exactly right. If you want to, I haven't talked to a borrower lately that's been foreclosed on in less than 2 years. That's 700 and some days.
Yeah.
And if you're concerned about the Debt Forgiveness Act, a foreclosure, stopping making your payment, you're done.
Yeah.
That's not an option anymore.
So the bad news is that you're going to have to turn over to the bank, typically what they ask for on the basic level is 2 years worth of tax returns, 2 months worth of bank statements, a hardship letter, and 2 pay stubs or a profit and loss statement if you're self-employed. So you're going to have to show them some stuff. The good news is, however, is that now there's a forecast of only 2 months of housing inventory for sale right now in the Valley, which means, and which I hear, grumblings from the real estate agents all the time that each house up for short sale has 5 or 6 offers on it. So
really?
Yeah.
It's the inventory is really low right now.
It would be a fantastic time to list your house for a short sale.
Right.
But what you want to do is make sure that your finances are squared away to the point that, you don't have, if you're going to have to turn over your bank account and not turn over information related to your bank account, let me put it that way, and you've got some kind of material deficiency going, you can imagine that their idea of what your contribution should be towards that deficiency is going to be directly related to what's in your bank account.
Sure. Well, that leads me to another question then. what are the chances of getting the short sale approved if you're not delinquent, if you're current?
I know people that have done several of them and not gone delinquent in their payments, and their credit is hardly harmed at all. I can promise you, Mike, I've seen it. I've coached a couple of close friends through it. I get calls every day asking if I would help them. You can do it, but the big key to that is you got to negotiate the short sale yourself. You got to be calling your lender like weekly, and you got to just thump them. But you can do it. And as Tisha said, you've got to have a valid hardship. You know, if you're making $300,000-$400,000 a year, you got a couple hundred in the bank. You know, your payment is $3,000 a month.
Yeah, but I can come up with I mean, I've had a hardship where guy had plenty of money, plenty of, no financial hardship to speak of, but he couldn't walk up the stairs anymore because he had a hip replacement. There you have it.
And I've seen one where they made great income, had incredible FICO scores, and well over 100 in the bank. And I know that person got 3 short sales done on 5 different mortgage loans and never had a late payment.
Right. So it can be done, Mike.
Okay. Thanks very much.
Yep. Thank you. Sorry, we talked right over you there, didn't we?
That's all right. You helped him out.
That was like dogs on a bone right there. It's a lot of meat, some stuff to chew. So I'm not in a good mood today, and I'm annoyed. This HARP program, although I do think that it is fantastic and it will help a good number of people, I have yet to see anything rational come out of the housing market, and it blows my mind that I actually still hear news stories that are like housing market. People are concerned. Housing market hasn't seemed to recover, or slow recovery in the housing market. Like a recovery, I don't even see a recovery yet. I mean, we're still. It's like the worst battle of the Civil War, which would be maybe Antietam. I don't know, one of the worst ones. We're still slogging through dead bodies on the field. I mean, I'm still smelling rotten carcasses and stuff. I don't see anything better moving forward.
I love Tisha's analogies.
I know.
I know I'm on a roll today. We should have more callers, so I shut up. But
they're calling to hear from you, to hear your advice.
But there are things that are coming out. So we have the HARP program, we have the multi-state, which does offer some,
some principal reduction.
So it does offer some principal reduction. Offer. I haven't seen it close, but I've seen them offer principal reductions.
But it seems like even with all these programs, it doesn't seem like I don't know anyone who qualifies for any of them.
You know what
no matter what situation they're in.
You know what people are qualifying for? They're qualifying for strategic default, and they're qualifying for bankruptcy. That's really what I see is happening, and the frustration level, including my own this morning, is just continuing to accelerate on trying to get some things done. But I do. I mean, not to get you in here to talk about HARP and then hate HARP. HARP is going to be a good thing for some people, especially our people on a fixed income. This is a fantastic program for people on a fixed income that have a loan that say they've had for 10, 15 years. So they're not that far underwater, and it can save them $300, $600 a month on interest rate savings. That's a game changer for a lot of people, and especially because we do have so many retirees in our community, and in the state, actually, in the warmer parts of the state, right? I think that it will have some beneficial effect, but it still doesn't get to really the heart of the issue.
It doesn't, and in reference to what you just said, we have not had but 2, I guess, retiree-ish people that have called to inquire about the HARP program.
Really?
Yeah, out of the 100 and some leads that we've had, and we've talked to a lot of borrowers and got a lot of loan applications, it's making a major difference in executives. We've got a lot of people who can't let their FICO scores, they can't let their credit get hurt because of their jobs. They're government contractors, right, or they're different things. We see a lot of that, and we're seeing
some of the people with privileged licenses too, or if they work
right.
if they privileged licenses like gaming licenses,
That's
those type of things.
right.
Or I know if they work in the cage at any of the casinos,
right.
Credit is
it's important.
Is very important for those people, and obviously people that work out at the base. But man, you got to run this thing through the retirement communities, through Del Webb and those, because this program is geared towards them. And I think the smart marketing on it, really to get to the people that it could help, is much like they used to do on that was it reverse engineering? What, reverse mortgage?
Sure, the reverse mortgages.
The reverse mortgages. But you got to have a sharp-looking guy like Robert. What's his face? Who's the guy that does the advertising? He used to be on Heart to Heart.
Robert Wagner.
Robert Wagner.
Yeah, just don't go out on a boat with him and you'll be okay. Stay here in the desert. Don't go out on Lake Mead. Might not come back from that negotiation.
You guys are...
But I think, what do you know about reverse mortgages, by the by?
I know that we don't do them anymore. We've got,
because nobody has equity anymore.
It was a nightmare to get them closed. The appraisals come in low. It's we've had lenders pulling out of reverse mortgages. I think B of A and Wells Fargo have both pulled out. Those are two of the largest mortgage companies in the United States, and if they're pulling out of reverse mortgages, there's a reason.
Yeah.
Right.
Hey, you told me something really interesting. You always tell me something really interesting, but you told me last week you were telling me, and I missed this in the news, that B of A said that they will no longer work with whom?
Fannie Mae.
That's unbelievable.
Well, that's going to help a lot of people. If no one wants to work with anybody else, that'll be exciting.
You've got two government-sponsored enterprises, Fannie Mae and Freddie Mac, are the two largest lenders in the United States, in the world, I'm sure.
Right.
I don't know, but I would guess in the world.
And Bank of America says...
Well, there's a lot of scuttlebutt. It's not my understanding that Bank of America said we're not going to do it. It's my understanding that Fannie Mae says we're not going to do business. They had repurchases.
Oh, Fannie Mae's not going to do business with Bank of America. Now, that's a whole... Okay, I could talk... that might put me in a good mood. Of course, they twisted it around and said, we're not going to do business with Fannie Mae anymore. The reality is what happens is when we do... we got to go to break.
Okay.
And when we come back, Tisha will be in a good mood. We've been discussing refinancing, the HARP program, and now a quote.
Yeah, so I just got this quote, which I love. And I know it's going to sound a little crazy, but wait till you hear who the quote is of. I believe that banking institutions are more dangerous to our liberties than standing armies. If the American people ever allow private banks to control the issue of their currency, first by inflation, then by deflation, the banks and corporations that will grow up around the banks will deprive the people of all property until their children wake up homeless on the continent their fathers conquered. Thomas Jefferson, 1802.
It's amazing how smart they were back then and could see what would happen.
Absolutely, because you know what? You can't escape greed. You cannot escape greed.
No.
I mean, all of us innately are greedy. And
greed is good. Gordon Gekko. There's my quote.
A certain degree of greed is good, but when you're so greasy that you put the whole continent under, then obviously.
They don't care.
So we were talking about my favorite, Bank of America now there was a bunch of buybacks. So let me explain that. Fannie and Freddie work under charters. Their charters indicate that they can only take a certain type of loan. If that loan winds up in their pool of loans, it sneaks in there, right? Let's say they can only have red shoes, right? And they all of a sudden get a green shoe. They find out that a green shoe snuck in. They have the right to put back or force a buyback of that green shoe to whoever snuck it in. So Fannie looked through their loans and decided that a lot of their loans didn't comport or didn't comply with their charter, the type of loans they could take. In other words, they weren't red shoes. And they went to Bank of America and said, you got to buy these back. And Bank of America refused to buy them back. And so then Bank of America then Fannie said to Bank of America, well, we're not doing business with you anymore, which means that now Bank of America is either going to have to securitize those loans and sell them on the market, which is a problem that we've been having with the bubble, is the securitized loans.
Or sell only to Freddie Mac.
Mm-hmm. Now, being that Freddie and Fannie are sisters companies, sort of, do you think that the impact of Fannie not doing business with Bank of America will have any effect on Freddie?
No, I don't think so.
That's amazing. That's amazing. One company. So
Fannie Mae was just cleaning up their we all have quality control at our mortgage companies. Mm-hmm. So we have the quality control. So what the argument was, it's my understanding, was over the interpretation of guidelines. So Bank of America said the guideline says this, and we allowed this, and Freddie Mac said, no, our interpretation says this. We're not buying that.
Well, we have a caller, Randy, on the phone. We'll go to that.
Good morning, Randy.
Yeah, good morning. Tisha, I was just wondering if you folks have heard of or have any information on a modification program called the Shared Appreciation Modification Program.
Oh, I've heard of that. Yeah, the Shared Appreciation Modification Program. Now, I don't know. And Mark, do you know what banks do it?
I don't, but it's new.
It is brand
brand
new.
new.
And what it is you get in, if what they do is they write your loan down to fair market value, and then you agree, they will relieve you of the liability of the deficiency. So if your home is worth $150,000, but your loan is $300,000, they'll write it down to $150, and then that deficiency of $150, you can start to sort of work it off. And as long as you stay in the house or the property, I think it's 5 years. It's 5 years or 10 years. I think that you will receive a full relief of that $150. But any equity created in that house beyond the $150 loan that you've got is then shared with your lender. Does that make sense?
Yes, that's kind of what I was under the impression of how it worked. Is there any place in town that is doing that, or is it something that you have to apply for out of town?
What? That program, they've been talking about it, and it's the nebulous they, right? It's been scuttlebutt for, I want to say, 18 months, 2 years, because it's so logical, right? I'm sure that regular business people came up with it, not people in the government. I don't know if it's been adopted yet. I know that it's being pushed around, but to me right now, in terms of, if anybody knows about it, please call in, because I think it's theoretical and urban legend at this point, Randy.
Well, the reason I'm asking about it is because a friend of mine is doing it.
Awesome.
Right. Who's your friend's service? Well, we probably shouldn't say who the servicing companies are.
I don't know that. The information he gave me was that you had to ask your lender for it. But I did find a place on the internet that was advertising doing it. But I'd
be careful. I'd be careful of that, because I don't know of any bona fide institutions that are doing it. And let me tell you, I had 4 website links pushed to me yesterday by people that were wanting to know if it was a scam or not. And most everything I have found on the internet with a private company, they're not most, I shouldn't say that. You just have to be really, really careful and look at the payment terms of it. It looks like
there's one servicer that's really thumping it right now on that, I believe.
And I think that's Aquin.
Yes, that's correct. That reminds me. That's the one I've seen. Yes.
Okay, so that looks like it might be legit, but just be extremely careful if anybody is touting the shared modification program and asks you to pay fees or compensation to them up front, that kind of thing. That's a sign of fraud. And Randy, call back in. And if I'm very interested in it, I was not aware that Aquin was actually involved in it.
Well, keep in mind, Aquin's a servicer. So if there's a lender doing it, right, that probably means that Aquin is servicing the loans for that specific lender.
Well, then here you have an issue of whether they have even the availability to write down or discount or get their investor that they're servicing a loan for involved in that kind of program. But you know what I'd say right now? These banks do nothing and they do everything all at the same time. So you got to, whatever sticks, and I'll say a prayer for you, because if you get in that program, that's awesome. Let me take
I'm like so many other people. I'm so far upside down, and there just doesn't appear to be anything, And I'm in a 80-20 loan, and I'm trying to figure out. I don't want to give up the house. We love the house and all that kind of stuff, and I don't want to, like I say, I don't want to give up the home, but you don't want to continue to pay on.
Well, you don't have to give up the home, but in a lot of cases, you become an indentured servant to it. So
exactly, yes.
Well, keep plugging away at that share program, and please call back in or call me at my